Why are markets going bullish this morning? Well, it's because we got durable goods data. It's like, wow, what's so exciting about that? Well, potentially avoiding a recession. See, there are a few trains of thought leading to the support of the bear argument. Number one is that Jerome Powell is going to turn into Paul Volcker. We're all screwed because we're going into a deep, dark depression. I think most people listening to this don't necessarily lean on that argument. I don't think the bears are that extreme. Although, of course, that is a tail risk, like a 5% risk that something like that happens. Whatever percent risk you think, it's probably on the smaller end anyway. I think most of the people who are bearish right now, whether you're in cash, you're like Steve and you love commodities, you just want to rub those commodities. The bear argument right now is very clearly that a recession is likely to hurt earnings per share substantially. And then once earnings per share are hurt, guess what? We go into a situation where we look at S&P 500 earnings, we look at the price to earnings multiples for indices, staples, stocks across the board, and we end up seeing, wait a minute, this isn't actually priced into markets, that EPS could plummet. And if EPS plummets, well then our valuations are too high and basically we've got a giant leg down further. Well, the data that we just got, called the Durables Good Orders data, gives some signs of brightness. Some signs. The year-over-year figure here, actually, this is actually all month-over-month data. So this month-over-month data gives us some individualistic data. And when we look at durable good orders overall, we see what looks like at first a decline above expectation. So the expectation was negative 4% on durable goods data. We got negative 4.5%. And the prior data of 5.6 was revised down to 5.1. That seems bearish, right? But when we start taking out the aerospace sector and the transportation sector, and we then just look at things like maybe cars, washing machines, dishwashers, other larger purchases for people and durable goods, what we end up getting is something that looks a lot brighter. So last month, we were sitting at a negative 0.2% for durable goods excluding transportation. That was actually revised lower to negative 0.4%, which isn't great, right? But the current report, so looking at January, the last report being the December report, the January report shows durables excluding transportation were expected to rise 0.1%. They actually came in at 0.7%. And that supports the argument that maybe GDP will be propped up a little better than we expect, and maybe we can actually avoid a recession. And that's probably why stocks are moving up right now, because of the expectation that, okay, look, yes, Paul Volcker is one of the arguments, but we want data that suggests things just aren't as bad as they are. Maybe because consumers and businesses have more access to capital, more access to debt. Maybe they're using more debt, although that's even started tapering down a little bit. Maybe they just have more cash and they can support still buying stuff. We go to the next line. We have capital good orders for the non-defensive sector, excluding aerospace. We were expecting no growth. What we got was 0.8%, which annualizes to about 9.6%. It's fantastic. Capital goods shipments for non-defensives, excluding aerospace, this is different from orders, this is now shipments, came in at 1.1% versus the goal, or the survey rather, of 0.2%. So you've got a nice beat here on orders. The likely explanation for why we're seeing, at least here in the early pre-market, or with early pre-market data, the likely explanation for the rise in indices here is that this is anti-recessionary, right? Now, this doesn't give us too terribly much inflationary data, but it gives us data that, hey, maybe things just aren't as bad as feared. Maybe the Fed isn't tightening as bad as feared. Consider this. Right before the durable goods data, the 10-year Treasury yield was knocking on the door of 3.98%. Within 30 minutes after the release of the durable goods data, the 10-year Treasury yield fell to 3.91%. So that means we were at about, we were rising on the day, and we basically fully U-turned on the 10-year Treasury yield. Maybe because markets are saying, oh, okay, well, these durable good orders are great because they suggest that negative GDP level isn't near just yet. People are still able to spend through it. So that gives us some insight into why we're seeing some of these indices move. Right now, Dow, S&P, NASDAQ futures positive, oil moving down again. Remember, there was this massive thesis, and I've been pounding on the table going, it's bullshit. I've been pounding on the table saying oil's not going to $100. People are like, but Kevin, China's going to reopen. It's going to go to 100. It's going to go to 100. And I'm like, it ain't going to 100. I think if you look back at my videos over the last 3 months, I'm like, this is nonsense. China was reopened for for like 40 years before the pandemic. And we didn't have massive oil spikes that weren't, predicated on the disasters that we had elsewhere outside of China. Anyway, a lot of other data suggesting as well that this was just a Wall Street institutional trade gone wrong. But anyway, Brent sitting down now about 0.5%, only at $82. That'll probably be trending towards the 70s here soon, especially as traders continue to unwind their oil positions, realizing that, oh crap, oil's not actually going in the direction they thought. WTI sitting at the lowest level that we've seen basically since even before the invasion into Ukraine by Russia. Now that is remarkable. Right now sitting at 75.84 is a level that we last saw in December of 2021. That's when the war, the invasion of Russia into Ukraine, wasn't even really a topic that was being covered. It was a fringe thought, a fringe idea. It was Western media hysteria back then. It wasn't until January we actually started seeing fears of the war actually occurring when oil started rising. But this idea of it heading back to $100 so far has been a faltering trade, and it's one that we saw the writing on the wall for. So great job, though, on the durable goods data. We'll see how the market ends up playing out on the day. But that's some of the movement you're seeing. A lot of folks asking me, by the way, hey, what about oil companies as maybe green tech investments? Just look at the earnings calls. Most of the green tech investments that the big oil companies are making are profit-losing endeavors that, in my opinion, are just being made for the political appearance of, oh yeah, we're an oil company, but don't worry, we love ESG, environmental and social governance, right? Anywho, look, I think the important thing to look at in the market is very, very clear. It's, are you betting on Paul Volcker coming? Then you're all cash. If you're not betting on Paul Volcker coming, then you want to invest in companies, in my opinion, that have strong pricing power. Not personalized financial advice for you. Even though I am a licensed financial advisor, it's not personalized financial advice for you. You want to look at pricing power stocks. Where are companies that are going to be able to maintain margin even through a potential recession? But so far, even the idea of a recession continues to get sort of kicked down the road more and more and more and more.